Good morning, everybody. Mike Tedeschi, investment strategist over at Perspective Wealth Planning. In this video, we're going to take a look at the larger time frame charts of the four major U.S. indexes, as well as some breadth readings, and we'll dig down a little bit shorter time frame as well. Just wanted to give a broader picture here as we head into the fourth quarter of the year. Now, what we've got up on the chart is the S&P 500. It's a 20-year monthly chart, and I've got two important moving averages on there. I've got the 10-month moving average, which is the white line, and I've got the 20-month moving average, which is the yellow. Now, in the last 10 years, I went and I circled the first time that the market closed underneath that white moving average, 10-month moving average. And we can see a lot of times that leads to some negative action, right? And of course, we got our first close back here, and then we had a real big sharp sell-off. We got the next close over here, and we basically traded sideways for 5-6 months before breaking out. We had a close under here and had a couple months of weakness before rising again. Same thing when we look at 2015 and 2016. We spent some time underneath that 10-month moving average, but was not able to further break down and ultimately pushed higher. And last year, we had that close under that 10-month moving average, and we had that horrible fourth quarter. Well, here we are starting our fourth quarter. This bar right here is October, and we are at that 10-month moving average. So if we were to continue to push down for the rest of this month, close underneath of that white moving average, that would be a cause for concern. Now, it doesn't always lead to sharp sell-offs. As we saw earlier this year, we had our May candle actually close underneath that 10-month moving average, but not that 20-month moving average, and we made that bounce back up. So it's not the end-all be-all if we go underneath that 10-month moving average, but it certainly would be a concern there when we take a look at that on the short term. Now, one of the other things to note, and I like to pay very close attention to, is when we get our MACD crossing over from, and we can see when that happened, we had our crossover back here on this candle where we had that sharp sell-off to start, the fourth quarter last year. The MACD crossed over right there, and we saw continued weakness for the next couple of months. Well, here we are making that crossover right here, and the histogram is also flipping negative. So this, of course, is an area for concern. But if we really take a close look here, right, we actually had it cross over a month or two ago and then reverse back over it. So even if we do cross, and we have right here, if we don't sustain that cross, i.e. if we don't continue to push lower, then we really have nothing to worry about. So we really need to see that follow through here to the downside, larger monthly bar next on the histogram, and then we would have some cause for concern. Another thing to note here is even as we have pushed higher over the last 2 years on a monthly chart, our RSI has not. This is what's known as negative divergence, right? You can see this line going down, this line going up. That, of course, is an area for concern. Now, the market can go up for a long time on divergence, but eventually that tends to always catch up. If we look here, we had the market rising this whole time and RSI starting to falter here. Really when we got into the beginning of 2015, and then we saw that weakness come in, and we saw that sell-off there in that August, right? When we see divergence like this, it doesn't mean the market is going to roll over or anything like that. It just says to be cautious, because if it does, it typically tends to have some follow-through, at least on the short term. So when we look at this monthly chart of the S&P 500, we have a couple of areas of concern, especially starting the fourth quarter, as we have with this amount of weakness, is giving us some cause for concern. Now, if we zoom in here and we take a look at the S&P 500 on a weekly time frame now, we've talked about this in a number of our recent videos, right? This could be a potential double top. The market rallied right up into that resistance zone and subsequently has had 3 solid weeks following to the downside. That is not what the bulls wanted to see. Now, the thing is, we do have, if you look at this, higher lows it's put in, and we draw a trend line right here, we do have some support right here at that 2880 level on the S&P 500. And if we take a look on a horizontal level, the most important zone that we're coming up to right here is, of course, that 2820 zone. You've heard me mention that a number of times over the course of this year. That was resistance during that debacle at the end of last year, and that also acted as support during the selling into August of this year. So that's an important level. When we take a look on a weekly time frame, we also have that MACD crossover. That histogram has flipped negative, so that's not exactly a big positive here for the market. Now, when we jump in and we take a look at this on a daily time frame here, right, we can see that we are, pushing underneath of that support zone here a little bit in Thursday's price action. We can see again that major important level right around that 28.20. Now, when we look at this histogram and we look at this MACD reading over here, we had that crossover about a week and a half ago, and we have accelerated here to the downside. So whatever time frame I look at, the action here over the last couple of sessions, really whether I look at it on a daily, a weekly, or a monthly, is a bit concerning here for the overall market, and is something we absolutely need to continue to pay attention to. Now, when we take a look at all of the major indexes, we're going to back this up. We're going to go back to the monthly. We're going to take a look at the NASDAQ here. Right? Let me clear all these drawings out for us. We have a very similar picture when we take a look at this here. All right, we have markets rising and RSI dropping. So we've got a negative divergence that is built up. We've got that MACD crossover here on the NASDAQ with the histogram in that negative territory there as well. And I have seen some people draw this pattern on the chart and call this a bearish rising wedge. I can see that. I can understand why you would take a look at that and think that that might be a possibility. But with any chart pattern, you have to get follow through in order for it to confirm, right? This pattern doesn't mean anything unless you were actually to break down, and then it would have some credence. So we will, of course, be watching that important level there. We look at the monthly. We're right on that 10-month moving average. We're still above the 20-month moving average there on the NASDAQ. Now, when we take a look at the Dow Jones Industrial, right? A very, very similar chart to the rest of them. When we talk about this on a monthly time frame, we have slightly higher highs, and momentum certainly has been waning. That RSI indicator has dropped. We're now underneath that 10-month moving average, and we are headed towards that 20-month moving average. Also a similar potential rising wedge setup. The MACD on the Dow has actually been crossed over since the end of last year. It has not actually flipped back to positive. And the histogram is continuing to push down. It looks like these are widening here to the downside. So that, of course, is also an area for concern. And last but not least, we will take a look at the Russell 2000, which, of course, has been extremely weak. We do not have that negative divergence because prices not continue to make highs this year. So we have lower highs, and of course we have lower on the RSI reading as well. We also flipped over on a monthly time frame all the way last year and have not turned back up positive, and it looks like that histogram, and we might have that selling pressure picking up here a little bit to the downside. We're right at that major level that we've talked about a number of times. I'll zoom in here on a weekly chart, right, and that is that 1450 level on the Russell. We can see the importance going back to 2017. It acted as resistance. Then when we broke through it, it was support. It was support again in 2018. It was support again and again and again. And then when we broke underneath of it, and then pushed back up through it. So really outside of, and we talked about this in one of the other videos, outside of about a month and a half here on the downside and a couple of months here on the upside, the majority of the last 3 years really on the Russell have been spent in between that 1450 and that 1620 level, and we are pushing on the bottom end of it, so we're going to pay very close attention to what happens over there. Now I promised you guys our breadth reading here, so let's take a look at that. We have looked at the NASI majority of these videos because I do think it is really important. We talked last time about there being that potential area of resistance right up in here, and we would need to be paying attention to see if we ultimately were to make that rollover, and that certainly is what happened, and we are now below that zero zone, -45 there. So major headwind in breadth reading. We got our crossover, and we're back in negative territory, and we can see, you know, on the daily chart here, really since that crossover, the market has seen that negative movement here as we head into October. Now, October historically is one of the most volatile months. We have had some of the biggest market crashes that happened in October. Doesn't mean that's going to happen this time. We just need to continue to pay attention to all the different signs that we're seeing, and what we are seeing is definitely cautious. We've got potential double top here on the S&P 500, but we still haven't left this support zone. So really, for me to really start getting concerned, we need to get underneath that 2820 level on the S&P 500. But again, when we back this up on a monthly time frame, we've got that negative divergence that is built up here over the last year or two. We've got that MACD crossing over, that histogram flipping into the negative side here, and that's just a reason to be extra cautious, especially with the headline risk that we're running into here as well. So stay safe out there, everybody. I hope you guys have yourselves a fantastic week. As always, I'll see you guys next week. Take care.